I'm Karunya Rao, and today on Ideas for Profit, we talk about Federal Bank. We had a strong positive recommendation on Federal, and needless to say, it has been a winner. A strong end to a challenging year with much lower than expected slippage, manageable restructuring, high provision cover, and granularity in business stand testimony to the fact that the bank's strategy has worked well in negotiating the first wave of COVID pandemic. The second wave of the pandemic might still pose some short-term challenges. However, given the quality of the book, it should bounce back faster than several others operating in that space. The growth in NII was much ahead of advances, thanks to the expansion in interest margin and lower interest reversal due to better asset quality. The much lower provisions was all thanks to bank using up previously created COVID provision, which resulted in a smart surge in reported profits. The bank has come out of the first wave of COVID decently, with overall slippages almost at the same level as FY20. However, credit cost was still high at 125 basis points as the bank stepped up provision cover from 55% at the end of FY20 to 66% this time around. Given that the bank has predominantly secured assets, it is comfortable with the present provision and is not carrying forward any buffer. The management also stands committed to step up provision should asset quality deteriorate drastically because of the second wave of the pandemic. The total restructuring because of COVID of about 1,400 crores is lower than the earlier guidance and is dominated by secured loans with only 6% being unsecured. Given the challenging environment, especially in the first half of FY22, wherein the collection efficiency is likely to witness a significant decline from Q4 level of 95%, we foresee elevated provision in FY22 as well. Reported GNPAs meanwhile stood at 3.41% and net NPA was at 1.19% by the end of Q4. After remaining lackluster due to difficult macro environment, the loan growth has shown good improvement with a 9% YOY growth in Q4, primarily driven by retail growth of 19%, whereas wholesale books saw some degrowth. One of the key drivers of the loan book growth has been gold loans that has shown a YOY growth of 70% in FY21, and it also formed 12% of the total advances. Given the fine spread in the corporate book, the bank is steering loan growth in favor of retail, SME and gold loans where yields are typically attractive. It is also adding high-yielding products in a calibrated manner without compromising on its risk matrix, which include the likes of credit cards, commercial vehicle loans, microfinance lending, etc. So far, the bank has improved margin riding on falling costs of deposit. Now the endeavor would be to improve spreads with addition of better yielding assets. We believe this strategy would succeed given Federal Bank has excellent liability that should enable it to pick up better quality assets in a competitive landscape. Thanks to a robust deposit growth in Q4, the bank is sitting on a comfortable credit to deposit ratio and can push growth pedal with return of normalcy. It has a highly granular deposit base with a share of retail deposits at over 90% and a steady base of NRE deposits of close to 37%. The bank has managed to reduce cost of deposits by 100 basis points in the past 1 year, aided partially by improvement in the low-cost CASA mix, which grew faster at 26% and formed 34% of the total deposits. Given the challenges in the financial system plagued with asset quality woes and inadequate capital, we see Federal Bank as a long-term winner with its conscious approach to diversify and de-risk asset book and build a solid deposit base. The adequate capital is an added draw and the bank is open to capital raising in FY22 to be growth steady. Yes, there are some key risks as well involved. Severe impact of COVID on earnings and asset quality should be closely watched out for, but we draw comfort from its undemanding valuation, which is one of the cheapest for improving ROA trajectory of the bank, and feel that any pandemic-led disappointment in the market or in the stock is a great opportunity to add Federal Bank for the long haul.